Are you curious about the stock market, but find all those charts overwhelming? Understanding how to read stock market charts is one of the most essential skills for anyone looking to invest or trade confidently. In today's video, we're breaking down 10 key points to help beginners unlock the secrets of stock market charts. From trend lines to technical indicators, we've got everything you need to get started. 1. Understand the axis of the chart. To read a stock market chart effectively, start by understanding its basic structure. The horizontal x-axis typically represents time, ranging from short intervals, like minutes or hours, to long intervals, such as months or years. This axis helps you see how the stock price or market index changes over a specific period. For instance, a 1-year chart shows trends and patterns over 12 months, while a 5-day chart focuses on short-term fluctuations. Selecting the right time frame is crucial for your analysis. Day traders may look at minute-by-minute charts, while long-term investors focus on yearly views. 2. Identify the chart type. Stock market charts come in various forms, and knowing the type of chart you're looking at is essential for understanding the data presented. Line charts are the simplest and are ideal for beginners. They show the stock's closing prices over time and give a quick overview of its general direction. Bar charts, on the other hand, provide more details, including the opening, closing, high and low prices for each period. These are useful for understanding the day-to-day price volatility. Candlestick charts, widely used by traders, offer the most comprehensive information. Each candlestick represents a specific period and shows the stock's opening, closing, high and low prices. Green or hollow candles indicate price increases, while red or filled candles indicate decreases. 3. Recognize key chart components. Every stock chart has essential components that provide valuable information. These include the stock ticker symbol, a unique identifier for the stock, the current price, and its percentage change. For instance, if you see a ticker symbol like AAPL with a 2% increase, it indicates the Apple stock price has risen by that amount during the trading session. Understanding these basic metrics is critical for interpreting what the chart is showing at a glance. Other key components include trading volume, represented by bars below the price chart, and additional data like price trends and gaps. Gaps occur when a stock opens significantly higher or lower than its previous close, often due to major news or events. By learning to recognize and interpret these elements, you can extract valuable insights from a stock market chart. 4. Analyze the time frame. The time frame you select on a stock market chart determines the kind of insights you can gather. Short-term charts, such as those covering a single day or week, are great for traders looking to capitalize on quick price movements. These charts reveal microtrends, intraday volatility, and immediate market sentiment. They're particularly useful for day traders or swing traders who need to make rapid decisions. Conversely, long-term charts, such as 1-year or 5-year views, are invaluable for investors focused on overall trends and patterns. These charts help identify the stock's growth trajectory, cycles, and potential for long-term gains. 5. Understand support and resistance levels. Support and resistance levels are crucial concepts for understanding price behavior. Support refers to a price level where a stock tends to stop falling and may rebound. It occurs because buyers enter the market, perceiving the stock as a good value at that level. Resistance, on the other hand, is a price level where a stock struggles to move higher because selling pressure increases. Identifying these levels helps you predict potential turning points in the market. For instance, if a stock is nearing its support level, it might be a good opportunity to buy. Conversely, if it's approaching resistance, it may be a signal to sell or prepare for a breakout. These levels are often identified by looking for repeated price behavior in historical charts. Understanding support and resistance empowers you to make strategic decisions based on predictable patterns. 6. Pay attention to moving averages. Moving averages are among the most reliable tools for identifying trends. A moving average calculates the average price of a stock over a specific period, such as 50 or 200 days, and smooths out short-term fluctuations. When a stock's price is consistently above its moving average, it signals a bullish trend Conversely, a price below the moving average often indicates bearish sentiment. Different types of moving averages, such as simple and exponential, cater to various analysis needs. Exponential moving averages, EMAs, give more weight to recent prices, making them ideal for identifying fast-moving trends. Incorporating moving averages into your analysis helps you understand the stock's direction and momentum, aiding in both entry and exit strategies. 7. Observe trading volume. Trading volume represents the number of shares traded during a specific period and is a critical indicator of market activity. High trading volume often signals strong interest in a stock, either due to positive news, earnings reports, or major market events. Conversely, low volume may indicate a lack of interest or uncertainty. When paired with price movements, volume provides insights into the strength of a trend. For example, a price increase accompanied by high volume suggests robust buying interest, while a price drop with low volume may indicate a lack of conviction among sellers. Monitoring volume helps you confirm trends and gauge the reliability of price movements. 8. Identify trend lines. Trend lines are simple yet powerful tools for visualizing the direction of a stock's price. By connecting consecutive higher lows in an uptrend or lower highs in a downtrend, trend lines reveal the overall movement of the stock. These lines can also help you identify potential breakout or reversal points. When a stock's price breaks above a descending trend line, it may signal the start of an uptrend. Conversely, a break below an ascending trend line could indicate a downtrend. Learning to draw and interpret trend lines gives you a clearer picture of the stock's behavior, making it easier to anticipate future movements. 9. Learn about technical indicators. Technical indicators, such as the Relative Strength Index, RSI, Moving Average Convergence Divergence, MACD, and Bollinger Bands, provide additional layers of analysis. RSI measures the strength and momentum of price movements, helping you determine if a stock is overbought or oversold. MACD identifies potential reversals by comparing two moving averages. Bollinger Bands, meanwhile, assess volatility by showing price deviations from a moving average. These tools, when used in combination, offer a comprehensive view of a stock's performance. While technical indicators are helpful, they should be used alongside other analysis methods to make informed decisions. 10. Focus on overall context. A stock chart doesn't exist in isolation. External factors like market news, economic data, and industry trends play a significant role in shaping price movements. For instance, a positive earnings report can lead to a sharp price increase, while broader economic downturns may suppress even the strongest stocks. Always analyze charts within the broader market context. This holistic approach helps you separate meaningful trends from temporary noise. Combining chart analysis with fundamental research ensures you're making well-rounded investment decisions, improving your chances of success. Which of these tips do you plan to use first? Let us know in the comments below. If this guide helped simplify stock charts for you, don't forget to like, subscribe, and hit the bell icon for more beginner-friendly tips on mastering the financial markets.